I'm, of course, Ilya Spivak here in San Francisco. That's Dylan Radigan in Milan. Thomas Westwater in Chicago. What a day it's been in these markets, gentlemen. The prophecy of Radigan continues. I believe the express instructions were buy dollar, sell gold, sell NASDAQ. Gold hasn't.
Radigan trade for nothing.
They do not. Gold has not gone very far, although it's certainly performing worse than silver, which is fascinating on a risk-off day like today. So gold is looking weak, relatively speaking, I suppose, because it's holding on by a thread here, whereas if we compare to what this looks like in silver, obviously silver is doing meaningfully better. So gold underperformance is as foretold, but the NASDAQ here is looking ugly and looked uglier earlier. But needless to say, we're looking at a third day of losses here. And for a while there, it looked quite a bit hairier than what this is. We've come back a little bit. And then, of course, the dollar. The dollar having a stellar day for a second day now, surging. So what do you gentlemen make of all of this? Dylan, you're the oracle. Thoughts?
I just, the reason I foretold this was only based on two things. One, price extreme, gold extreme highs, NASDAQ extreme highs, dollar extreme lows, and the watershed of the Fed meeting. Mm-hmm. So the Fed meeting as a point of inflection, as a point of, I guess, not even inflection, the Fed meeting as a point of as an opportunity to reflect on price extreme. Because I would say that the price extreme was largely primarily propelled by AI Supernova 1, crazy Donald Trump 2, which means weak dollar, strong gold. But I think crazy Donald Trump, it's not to be underestimated that crazy Donald Trump has taken a major setback in the last 2 weeks. And I think that's part of the reason why you're seeing the gold sell off and the dollar strength, because the gold strength and the dollar sell off is a direct reflection of the degree to which crazy Donald Trump is perceived to be invincible and credible. And the president over the last 2 weeks has proven to be fragile and vulnerable, which I think is bad for the president, but really good for the integrity of the U.S. economy, the U.S. currency, and then ultimately negative for the risk-off position that is the dollar. And I'm referring specifically to his obvious attempt to intervene on the First Amendment, which was rejected, even if it was rejected for commercial reasons. And I don't think he'll stop doing that, but at least it was rejected. And then his performance at the United Nations, and then honestly, the comment about Tylenol. So I just think the fact that you're finally getting sort of Republican leadership saying, I think this man is not a credible leader of people, is what's bad for Donald Trump is good for the US dollar and is bad for gold. And what's good for Donald Trump is bad for the dollar and good for gold. And I don't know that that's the primary activating characteristic in this situation. I'm sure that it's not. I think the primary activating characteristic in this situation is really just price extreme and time, compounded by an opportunity to reflect based on some comments from the Fed, and specifically the Fed not just cutting rates, but offering some caution as to how many more rate cuts might exist. And I think you put it all together, and it certainly was the reason why I offered the prophecy. And it's the reason why I'm satisfied with the result at this point in time. I still think the prevailing dynamic is the AI supernova. And I still think the prevailing dynamic is up and to the right, especially when it comes to the equity names that are directly or adjacently tied to the supernova. But I just think we're at a moment where on the macro level, particularly gold dollar, where I'm more confident in gold dollar, meaning lower gold, stronger dollar, than I am on short NASDAQ. Just because gold dollar is less complicated by the AI supernova. And whereas the AI supernova, adds a little bit of resistance to any sell-off. And even myself, as I was talking about yesterday, anytime there is a sell-off on the NASDAQ side, especially on the Mag 7, I think you buy dip, just because I think the supernova is stronger than any price extreme or any presidential shenanigans or any Fed rate cut or any growth expectations. But I do think that gold's behavior and the dollar's behavior have been really a reflection of sentiment around the credibility of American political leadership. And I think that the strength in the dollar and the weakness in gold correlates to the fact that for the first time in Trump's presidency, we're getting Republican leadership like Ted Cruz, not just Ted Cruz, but Republican leadership, including Ted Cruz, out in public saying this is crazy and we shouldn't continue down this path. And so I think that, because having the emergence of public Republican resistance to his leadership, I think is not insignificant. And I think it's so obvious that sort of saying that Tylenol is the cause of, any sort of negative medical outcomes, absent substantial research, considering the history of Tylenol, just doesn't do well for the credibility of anybody who says that, let alone the president of the United States. And then also the sort of direct assault on the First Amendment, which is inherently sort of existential to the American identity. Even the most conservative Republicans don't want to see the chosen president deciding who gets hired and fired based on what they say in public. And so I just think all of those things actually work in favor of the strength of the dollar and work against the strength of gold. Like I said, the NASDAQ seems a bit more complicated to me just because it has the offsetting factor of the supernova.
So this naturally brings a couple questions. And Thomas, I'm curious what you make of this, because I would generally agree with Dylan's assessment, but I think we have to take into account here two questions. The first one is the influence of economic data, which we can see with the naked eye here on the screen. We can see where the dollar jumped. It was exactly when today's batch of economic data came out, in particular, the upwardly revised GDP report, as well as sort of the assortment of other things on the menu that came with it. The PCE report, the initial jobless claims bit, durable goods. We should point out that all of the key data today registered hot. Durable goods, much hotter than expected, 2.9% versus a decline expected. An upward revision on second quarter GDP data, an upward sort of a labor positive, let's call it, move on jobless claims, lower on initial jobless claims, lower on continuing claims, lower on the 4-week average, on and on and on. In fact, the 4-week average here at a 4-week low for jobless claims. So all of that comes out right here. And it's not shocking, of course, that the dollar runs on this, but when you look at what then happened with NASDAQ, that's a little bit different. That's later. And so you'd have to go like somewhere over here. And it is a negative influence on NASDAQ, but the real push in NASDAQ comes later. So how does this all come together in your mind, Thomas?
The GDP data, it's a nice boost, but it's pretty backwards looking data. I think tomorrow's inflation data, if it comes in line, if it comes slightly below, I think we get more of more dollar strength, more equity strength. The thing with equities, why I'm not getting long here, is a lot of this is already priced in. We're coming to the end of the month here, and I think valuations, a lot of investors are focused on, are earnings going to continue to expand? So if you get an economy that's still trending above consensus, I think those earnings are likely going to continue to expand. I think this AI supernova thing, it's going to continue to push us higher into the end of the year. So the only real risk I see into the end of the month is this inflation data coming in hot. I think that's possible. I think the Fed's going to continue to be driven more by labor market conditions, and we've seen them moderate somewhat. But I kind of think, and I think Powell said this, but I kind of agree. The tariff impact, it's not going to only show up through slightly higher inflation. It's showing up through a hiring slowdown. So
Absolutely. That was one of the more insightful things that Powell had to say yesterday, was saying that part of paying for the tariffs by businesses and insulating consumers is less hiring.
So I mean, we've bucked the trend of this September seasonal weakness, barring anything crazy happening over the next couple trading days. I think that's a big bullish sign for the market. I think we get inflation coming in right at target. I think it's going to be a green light for the next push higher. At the same time, I'm getting short non-US dollars, so essentially long the dollar. I'm already short Canadian dollar. Trying to get short the euro right now with an order in for selling a call spread against it. And I got long gold today, so it seems like I'm doing something different than you guys. But I think this pause here in gold, I think it's just it's just that it's a pause until we continue the trend we've been on for months and months. The interesting thing is that the gold silver ratio, we're on track to put in the 5th month of the gold silver ratio going lower. So we've really had silver play this catch up game. It's not that gold's fallen, it's that silver's really caught up. So I'm thinking that trend is going to continue, and thinking about getting long silver too here on the next program.
I have been first long gold and then long silver, and guess we can do it like this just to keep things simple here. And what I did yesterday was take that off. So take gold off, but keep silver on, and that's helped here. So what we're looking at right here is for some reason tied to XLF. Here we go. Interesting. And let's see if we can do it with the futures. Perhaps that will work a little bit better. Okay, so what we're looking at here is the spread, and I think we can see here sort of how this has developed and what seems to be then is this rebound in silver in relative terms. So if I'm following here, Thomas, you're looking for this to continue higher.
Yeah, I think silver will continue to outperform. But that comes with, I think gold's also going to perform. So it's just silver outpacing gold. It's not gold falling and silver rising. It's silver rising relative to gold rising.
And to your point here, and we'll get back to this chart of rates in just a second. Here's gold. And if we look here on the daily chart, it's pulled back. But if you kind of guesstimate, here was former resistance where we caught a little bit of an inflection point right here, and we're holding above that level. So we're sitting here. I mean, essentially, if we look at a shorter time frame chart, we're basically sitting on what is the line in the sand, where if you took out this barrier here, then maybe you're looking at something a little bit more outwardly bearish. But for the moment, this looks not unlike the stair step here, where here was sort of a similar horizontal level. We broke up and held, and then that was a launch pad for the next leg higher. And so it'll be interesting to see if this then is something similar. I'm not on the long side here. I was, but I got out. And took my profits. Here, obviously, much more spirited, although should point out that there's negative divergence here, so maybe momentum is getting a little stuck, but we will see. The thing that struck me today was what I was looking at momentarily, and we can look first at SOFR here for year end, and we can see that it's not exactly what you would expect for this year. So right around, let's go to a 15-minute chart here so that we can see. Here's the data, right? This is the GDP, jobless claims, durable goods, etc. And of course, this is the price of this 3-month Fed interest rate futures contract, and this is telling us where it's going to be at the end of the year. So to get the implied rate, just basically imagine this chart upside down, because what it's going to be is 100 minus this quote, 96.26. And so what this is, so to think of it in the same terms as interest rates and bond prices going inversely, this is bond prices going down, so it's, or rate futures prices going down, same thing, and rates going up. And so here's that data right there. So it's not shocking really to say, oh, well, the dollar is higher because a bunch of hot data came out. This is not going to be helpful for Fed interest rate cut expectations. Not surprisingly, those expectations are off. Things look less dovish, higher dollar. I mean, that's not exactly rocket science here. And if we now look at December of next year, same thing. So what this did was it made for a less dovish policy outlook all around.
It's not just saying they
year.
won't be front loaded, right?
Of course.
Right.
Of course. And so what this is essentially attempting to tell us is the entire rate structure from now through the end of next year got less dovish today as a consequence of this data, which kind of lines up with the Fed's forecasts, right? When they gave us the updated SCP, we had a situation where they said, okay, yeah, here's your cut. Our balance of risks has changed. Also, we're upgrading our growth expectations and inflation expectations and lowering our unemployment rate forecast. And you're only getting one cut next year. So all of that seemed to say what the Fed is doing here is saying we're going to run the economy hot because this tariff inflation is going to go away by itself eventually. And Powell said by year end in his speech yesterday. So you get hot data, dollar rallies. Okay, cool. What's interesting about this is indeed the performance from the metals, because you'd think this would be bad news for metals. And when you look at where that is, I mean, momentarily, it is bad news. And then not. And I think this really speaks to what Dylan is saying here, which is that this is not just data. Here's that same thing. Bad for metals because the economy is going to run hot, and then not only do we erase all of it, silver keeps going. So this seems to be more than just a stronger dollar, although obviously a stronger dollar follows from this data and the shifting of these rates. This seems to be more like the kind of risk aversion that the dollar benefits from as a haven currency now. And
I mean, I guess my thinking I'm thinking about, Ilya, is in your sort of with your sort of preference and experience and knowledge of technical patterns. If you go back to that dollar chart and look at the sort of surge in the move, How much of is that a convert? Like, does that make you want to get more dollar? Does that make you want to get longer the dollar?
I got a little bit longer today.
And in other words, the momentum to the upside tells you that there'll be more of it.
Yeah. So when I was looking at this today, and I'm not trading the dollar index, I'm trading the dollar against individual currencies. So I look at this today, and when you look at the dollar index, you get the sense, oh, well, you're at some sort of a range top here. So maybe you'll run into some kind of a barrier, perhaps. But I think when you look at the individual currencies, here's the Aussie dollar, and full disclosure, where I added today was here. When I was already short, but I got more short. When you look at kind of the makings of this, you had what looked like this barrier right here, sort of whatever this bottom was. And when we cracked this today, I mean, I was already short when we cracked something similar here, right? Here was this level. I got short there. Now I am more short. Similar story for the euro, although I was already short that one in full size. So I started selling it a little bit early, but again, this is a convincing move. Now you might get a little bit closer into the bottoms of this range here, so maybe you get some kind of a bounce first. But if we get anywhere in the vicinity of let's say on approach to 118, maybe here somewhere, 1770, 1780, I'd be looking to add. The pound is probably the one that I'm watching the most, because I think that's one where I'd like to have a bigger position on, and where there's clearly this low here, which might give us a little bit of a reaction bounce, maybe somewhere into here. And that would be an attractive sell, sort of against these levels here, whatever that is. Similar story for the Canadian dollar, which looks to have broken out here, as has the yen. So the Canadian dollar here, there's your former low. You can see it very clearly. There's this very well-defined range right here. In fact, you could even, if you went to the continuous contract, you could even go back further here. Basically say, here is some sort of a range right there, and you're essentially cracking it. Now, you can't really see it on the continuous contract, but if you look at the current one, that range is gone. You're through it. And of course, the key thing here is the continuous contract is indicative. It's not a tradable instrument. This, on the other hand, is a tradable futures contract here. So this is what matters. So that's another one. On the yen, similar story. This was its kind of internal range that held for what, going back to early August, and basically up through yesterday. Now you're up against this low here. This is the August 1st low. You're not quite through it yet, but whatever congestion was here has clearly given way. So I'm already short this from back here, but if it were to crack this, I would sell more. So I'm loading up on dollars here. I am very curious about sort of this idea today that the dollar is responsive to the data, yes, but also responsive to risk aversion and sort of the larger move in stocks, the larger move in metals. And to that end, Thomas, I wanted to bring up the images that you shared with us earlier. Let me see if I can put them up on the screen. And this is sort of political risk, to Dylan's point, as a catalyst. So talk us through what we're looking at here.
Yeah, so these are some of the notable government shutdowns that, lasted a day or more, going back the past multiple decades. And, we see this one that started in late 2018 to 2019. It was 34 days, 35, somewhere around there. You see that the S&P 500 gained about 9-10% over that 34 days. The green line on the chart shows us there's a positive correlation with prices in the S&P 500 tend to rise more than they fall during government shutdowns. So, if you hear the CNBCs and some other financial outlets, they're talking about there's political risk from a shutdown, saying, it can increase volatility and things like that. And the data, it really doesn't show that. It shows that, the S&P 500 actually increases during government shutdowns. And, that's kind of skewed in a way because most of the time you are in a bull market and, these government shutdowns occur in bull markets, with that being the case. So, what you can kind of say is that, if you're in a bull market and there's a government shutdown, that's not going to be the reason for equities selling off. They're most likely just going to continue to do what they do. But if you're looking at on face value, equities continue to rise most of the time during government shutdowns.
So make this, well, before we go to your next image here, why do you think this is? What is it like? Obviously, we can see the data here clearly. And also clearly 2018 to 2019 is sort of the most extreme outlier here. I mean, that's obviously very strong. So with this in mind, is there a logic here that's discernible? Is there a narrative, sort of why a government shutdown isn't bad news for markets? Have you kind of theorized what the cause and effect here might be, or is this just look at the data, don't think, just read?
I think it's that government shutdowns they generate a really newsworthy headline, right? They're it's a big news deal for to attract attention. The government's shutting down. Most people.
Yeah.
It's bad, of course. You don't want that to happen, but the markets obviously most of the time they look past this because it's going to be, in most cases, short-lived. And the outlier that we do have, 2019, that's actually one of the longer government shutdowns that have occurred. Usually they're just a few days, 1, 2, 3 days, right? But the big one we saw, 34 days, that's actually when stocks rose the most. And it kind of makes sense because the duration's longer, the market has more time to go up if you're already in a bull market. But what I take from this is to just kind of look past the government shutdown. Don't really change the way you're operating based solely on the government shutting down or potentially shutting down. And what it looks like right now is we are going to get some kind of shutdown. The question is, how long is it going to be?
Now, reconcile this with this other image that you have for us. See if we can get that one up here. And talk us through sort of how this factors into it. This is a chart of gold as relative to the S&P 500 during shutdowns.
Yeah, so you see, you could kind of look at this like a linear regression. So there's still a positive correlation, but albeit much weaker than S&P 500. The data is kind of scattered, all over the place, which is why you get this weaker linear trend. So my thought first before I ran this data is that gold would perform better during government shutdowns, right? Because it's gold, it's a safe haven. You would think a government shutdown takes away confidence in the U.S. government. That it's just not really what we're seeing. So this chart doesn't really give you as clear of a signal as the last chart we looked at. So it's kind of more a chart to illustrate that maybe your first thought that gold would outperform during government shutdowns just isn't necessarily the case, or that a government shutdown really doesn't even have much influence on the price of gold, and investors instead focus on the broader macro themes of what's driving gold in the first place. And also, the S&P 500, since you're mostly in a bull market most of the time during equities, that's not necessarily the case with gold. So that confounding factor that's at play with the S&P 500 might not be playing into the data as much as we see right here.
Well, and this is interesting, right? Because when you look at this, you at least have a relationship, right? When you look here, the chart looks almost flat. So if you wanted essentially to have this kind of one glance linear regression type view on this, then you might say, oh, okay, well, this line is pretty horizontal. There doesn't seem to be a positive relationship between how long the shutdown is and sort of the interplay between gold and stocks, whereas here, looking at just the duration of the shutdown and stocks, there's a clear sort of positive slope to this line. So if you wanted to just look at this at a glance and say, well, the longer the shutdown, the worse for stocks, no, actually. Right. It's the other way around. Fascinating. So in kind of considering this then, whether we get a shutdown or not, obviously, time will tell. But as we sort of look at this and think, okay, so Dylan was telling us ultimately the supernova lives, and the thing to do in situations like this is to buy. So Dylan,
and not to think about it.
And not to think about it. So Dylan, are we buying this pullback now? Is this done?
Unknowable. I mean, that no one will ever be able to answer that question correctly. There's one you can buy a little and wait. You can wait. There's no right answer. All I can tell you is if you bought it today, it's less than it was a week ago.
Yeah.
But that doesn't mean it's not going to be less next week. I mean, this is sort of where, Sosnoff would hate this, but sort of, incremental positioning, takes on merit when you're in a price reduction moment. You don't know if prices are going to keep getting less or not. It's impossible to be able to answer that question. All you know is that it's cheaper today than it was a week ago. And you want to own it.
It's interesting the IVR is so low after this pullback too. I mean, there's no volatility here.
But isn't that a reason more to? I mean, I would say that's a marginal reason to buy it.
Right. Yeah. I'm going to be buying tomorrow if the inflation data comes in line.
Yeah, I mean, I think it's very interesting that if you look at kind of where the NASDAQ held today, and I sold some, but if you look at sort of where this is, I mean, this is about as clean of a hold in a sort of obvious spot as you might surmise. So if this was your former kind of point of friction, and this kind of range here between the close and the high is where you would expect support to show up, it's where it showed up.
And you got
Right
those
there.
long wicks too on these candles,
Yes.
showing that
Yes.
there are buyers down there for sure.
Yes. It's telling you exactly right. Exactly right. It's telling you that there is exhaustion in these candles where you try to go all the way down here, and it's not like you closed a little bit off the lows. You came all the way back. And
Yeah.
that's not
Sign of confidence.
yeah, that's not something that looks terribly bearish. But at the same time, the sequence here is pretty clear. Lower highs, lower lows. So ostensibly, one way to look at this is to say, oh, look, it held this support. Another would be to say, well, yeah, it also held this support until it didn't. It also held this support until it didn't. Are we stair-stepping lower now? Is this kind of a top that's been rounded? And I think Dylan's right. It's impossible to know. The real question is, do you sell here? Do you buy here? Or do you do nothing?
Or do you
I sold a little bit here, essentially on the idea that the break of this, sort of this break there, and the retest under is actually indicative of bearish momentum building. So if you wanted to just kind of look at the way that this has stair-stepped down, it's sort of something along these lines. So step, break, retest, and then if, unless I am wrong, break, retest, on and on and on. So I approach this from the short side today, and for that matter in Russell as well, and I was short the S&P since earlier in the week. Thomas, are you buying this dip already? Are you waiting, or are you selling?
I'm waiting
Dylan,
until
same
tomorrow.
question for you.
I'm waiting till tomorrow on the inflation data. So inflation data comes in line or below. I'm going to buy this. I think it's a decent pullback to get long exposure if you've been waiting for a dip. And indeed, we are going to reverse higher and keep this longer term trend alive. I think this is probably a good price point to buy.
Dylan?
I think ultimately the only way to deal with a situation like this is, position is size management. It's an unknowable.
Yeah.
So I'm not going to pretend that I can answer that question. I mean, I can have an opinion on a price extreme and all the rest of that. I obviously can have strong opinions, but relative to an entry point in the middle of a sell-off that could go down another 5% easily, maybe even 10. I mean, this thing's out of hand. But I think that there's a lot of people out there that, like, the bigger risk, I think, is waiting too long and you miss it. I actually think you're better to go in small and be early and get beat up a little bit and get some more than you are to sort of try to time it perfectly, pick the bottom and miss it.
Yeah.
But all of it's unknowable. I don't know what to say. I'm sorry to give you a mealy mouth answer, but I just don't see how it's possible to really. The only way you manage risk in a situation like this is with size.
I completely agree. So I look at this and I essentially say, okay, well, the trend is down until it's not. So right now, lower lows, lower highs. So the path of least resistance, in my mind, is this was support. It was support here. It was support here. We came off it to retest this former support, now resistance, and then we cracked down. We came to retest it and held. So, okay, let's look for this to continue. If, on the other hand, you take this sequence out and end up somewhere here, the trade's wrong. And you should be long. And what this is a trend higher, and within that you have a pullback and a kind of resetting of the slope, and whatever happens on a break this way, then on and on we go, if that's how this goes. And so those are kind of my general bearings, that we're going down until we're not. And when we're not, then that's the time to be basically turning the cards over. The way I've structured my exposure here is through verticals, because again, vol is obscenely cheap. And so you can buy these puts very, very affordably and get locked in 2-to-1 risk reward on basically any expression of this. I mean, what I've done here is done it through ETFs. And if you went out, let's say 64 days here, and you said that what you wanted was a put vertical basically from here, and let's say you gave it maybe to here, sort of nothing crazy, you can already see how this comes out to sort of close to 2-to-1 risk reward, just to go out to kind of the next decent pocket of liquidity. And that's 64 days out. I mean, if you wanted to look at the trade I actually have on, it's this. This is literally the spread that I have on. And you can see the risk reward here comes up even a little bit cleaner. And you can do these things. I mean, it's almost 2-to-1, not quite, but obviously this market is currently closed. But this is kind of straightforward, and then if you're wrong, then your risk is defined and you're wrong. And sort of worst case scenario, it expires worthless and the loss is small. But rolling the dice relative seems to make sense. And so just because the vol is so cheap and the trend is there, so if it's there, then let's find out. Similar story here in the S&P. Here, also a kind of similar anchoring around a level, maybe even cleaner. I mean, we were way down here earlier today and obviously held, but at the same time, here was the former stair step, and here's the former stair step before that. Let's call it something like this, maybe. So it seems to be doing this same thing where it sort of steps, then breaks and retests, breaks and retests. And then we'll see if tomorrow we break with more conviction. But again, the series seems to be still lower highs and lower lows until it's not. So same logic here. And then finally, Russell, which took a shellacking here today as well. Again, sort of similar ideas. Here's the bottom of this range. We held about there. And we're stair-stepping this down also, where this was, give or take, the former level, and we're sort of edging past. Let's take a look at crude oil here, because this seems to be catching a little bit of momentum, where we've finally kind of come out of whatever this wedge-looking thing was today. And I wouldn't say we've quite crossed the Rubicon, because we're at this former high and we stopped right there. But does this entice either one of you? I mean, vol is still pretty low here at 11. Any appetite for crude oil here?
I'm
I don't
still
go near crude oil unless there's geopolitics involved, and this feels more like inflation and economics, and I feel like it could go. It's hard for me to really offer a point of view. I mean, I do, the price level gives me a little interest just on your technical lines.
Mm-hmm.
It's not really my thing.
Thomas?
I'm still in my iron condor, so you know my put side's at 60, 59 and a half. So I'm probably going to get out of the put side on that tomorrow, and then I'll keep the short call spread on for a little bit, hoping the price retraces to the downside, and then take that off with the duration running out here on this trade. I mean, there's these drones and Europe saying they might start shooting down European incursion or Russian air incursions. I mean, that's a slippery slope, because once you start saying that, and if Russia does it again and you don't do that,
we won't allow Syria to have chemical weapons. That's a red line. Chemical weapons are had in Syria.
Yeah, once you say that, it raises the bar a little bit in terms of the risk, because the risk is if you actually shoot down a plane, then that's an escalation. The risk of saying that and then you don't is also in a way an escalation, because you're emboldening the other side to continue or potentially increase that type of behavior. So I mean, the temperature, I think, is still a little hot with geopolitical considerations. And then, diesel inventories are the only concern of all the fuel products in the world. So, inventories through the year are higher than where they were at the start of the year. And yet, these prices, they're increasing now. So I'm going to stay in this iron condor, with the hopes that the price backs off a little bit here now.
Yeah, I don't have exposure here at this point. I think the risk reward is basically shot. When you're right up against resistance like this, there's really not a whole lot that you can do. And so as I look at this, then it sort of suggests that either we're going to get a breakout or we're not. And if we get a breakout, okay, cool. And if we get a pullback, okay, cool. Let's maybe take this out. The hotness of the economic data today would suggest that as a cyclically kind of inspired asset, this should be going higher, but it didn't really make hay of it today. And so maybe this is soggier than meets the eye, and ultimately this is a thing that fails and kind of skids into a break lower, but we're going to have to see. Last thing that I wanted to get a sense of from you guys is this sort of interesting relationship between Bitcoin and risk sentiment, because we can clearly see here Bitcoin started selling before stocks did and kind of tipped the hand of it. In fact, it's been soggy going all the way back to mid-August. Does this tell you anything? And
it tells you Bitcoin is not a store of value. It's not gold, right? I mean, the thing with Bitcoin is there's always a story. There is always a story, asset. Yes. It's a fiat alternative. Bullshit.
Digital gold, blah, blah, blah.
It's a risk. It's a highly speculative risk on asset. And as the market goes risk off, it comes in. I would say it's just the edge of the risk on speculative pool. It's not a hedge on anything, and it's not a currency. It's just the casino chip at the edge of the speculative tunnel that's primarily pumped by people that have gotten rich by owning it and who are self-interested bullshit artists.
Amen. Needless to say, you don't need to convince me of any of those points.
But regardless of our emotional or our sort of psychological sentiment,
Yes.
price action shows you it's not a risk off. It's not digital gold.
Right.
Risk on asset that sells off in a risk off environment.
Thomas, you have anything to say for digital gold, quote unquote, here?
I mean, I don't really have anything to say on this. The market goes risk off, it sells off. I mean, I largely agree with Dylan. There's, I don't trade these products much. I'll look at them to get a gauge on sentiment, but I think it's just reflecting a pullback in sentiment here. If it drops below the early September high, then maybe a bigger pullback. Maybe some people are seeing it as a buying opportunity here, and I think that's kind of the same way you would operate in equities if you're thinking you're at a good level and you want to add some risk here. I think if we go risk on in the equity market, do you see this bounce back? That's what I would presume.
Right. Yeah. I mean, I think that resonates.
You could argue that the fiat currency argument holds up if you look at the dollar rally to support the sort of alternative currency narrative. Stronger dollar, weaker Bitcoin matches in that context.
Yes, it does. I mean, and that's sort of why it's so interesting to say, okay, well, what makes this thing anti-fiat? Okay, well, it's not a government currency, but it is a sort of unit of value, or at least something that is, to some extent,
it's not a unit of value or a currency. It's an expression of sentiment.
Yes. And so,
measure of sentiment, right?
And this is where it gets interesting, because you look at the kind of expression of sentiment that gold is, right? Another kind of non-fiat instrument of holding value that doesn't yield anything. And whereas gold is up today a little bit, silver is up today a lot, this thing is down with stocks, which sort of tells you what kind of animal this is. And so very much agree with you that this is not kind of like, yes, I am the perpetual Bitcoin and crypto skeptic, because I think the whole thing is more like a digital tulip, more so than digital gold. But all of that aside, just the price action here now, sort of how the market views it, seems to be clearly not whatever gold is. Before we wrap things up here, gentlemen, any final words on this PCE data that we have coming up? Just by way of context, we're looking for the core rate to rise to 3%. That would be the highest in 19 months, which is pretty incredible. That will be the last time that we had a greater or equal to 3% handle on the core rate. The headline expected at 2.8. That would be the highest in 17 months. But obviously, the Fed is telling us not to worry our heads about this, that this is a transitory thing again. Rather than attempt to speculate whether inflation is going to be sticky or not sticky, which I don't think anybody knows, let's kind of do a quick scenario analysis. Good data is good. That is to say, data up, sentiment up because the economy is strong, or data up, sentiment bad because fewer rate cuts?
Are you saying data up as in inflation comes in under
as in
target?
like more inflation sentiment good, more inflation sentiment bad?
More inflation sentiment bad, I would say.
Okay. I would agree. Dylan?
I agree. I totally agree with Thomas. I think more inflation sentiment bad. I mean, I think that's the biggest risk. I don't believe that the tariffs are transient.
Me neither.
Doesn't make any sense. I
No,
think that how tariffs are not transient. And if you think that inflation is transient because of the tariffs, it means you think the Supreme Court is going to rule that tariffs are illegal next month.
Yeah, I mean, I get this idea that, like, okay, you get a rise of 10%, let's say, on a given country's imports, and over the course of a year-on-year adjustment, it's going to kind of rebase the data, and the impact is going to rebase out of it. But that doesn't mean that consumers don't now have to pay 10% more for whatever the thing is. They do. And that's going to have not only follow-on effects on consumption, it's going to have psychological effects. We've seen how bent out of shape people get about, oh, eggs are XYZ more expensive. And you're like, yeah, but so are wages. And people go, well, but I see the eggs in the store every week. And wages haven't kept up until, let's call it, the past 6-9 months. So it doesn't feel good. The sticker shock is high, and that further undermines consumption. So I think it's bad news too. All right. With that, gentlemen, overtime is out of time for today and for this week. Don't go anywhere, anyone. Macro Money is coming back right after a short break here, where I'll talk us through torturous detail about this PCE report that's coming up. And we'll be back with this wild bunch first thing next week to try and figure out what happens next. Thank you, gentlemen.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
The future of trading is here. Join Mike and his whiteboard, plus the tastylive crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
When you define risk, you set a limit on how much you could lose if the trade goes bad. If you have a small account, you might not be so interested in selling naked options. You'd use up much more buying power, and the risk is undefined. Defining risk, though, controls how much you can lose if the trade goes sour, and it gives you back some of that sweet, sweet buying power. We can define risk by combining options into certain strategies. The short put vertical spread is the simplest one. Selling this put sets your max profit with the credit, and the long put at the lower strike blocks off the risk where you want it. And if you're more neutral than this, you can throw on a vertical call spread to make it an iron condor. The only downside to defining a risk is that it lowers both your max profit and your probability of profit. That little compromise might mean you rest easier, though, and a good night's sleep is priceless. So see, we can define risk when we use more than one option at a time. Pretty simple.
Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at tastytrade.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, two female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
Frequent trips to Vegas, or there was a year I did a couple of them.
What's the most financially irresponsible thing you've ever done in your life? Doesn't necessarily have to be trading specific.
Financially irresponsible, that's a big question. Like people would say like going to college these days, I don't know. Renting, I like renting. I like the flexibility. I don't know. Maybe renting, I guess, by the book is financially irresponsible. Actually, you know, my biggest purchase right when I started my job was $4,000 on a PC setup, which was not a good idea at my salary point.
I mean, anytime you take a trip to Vegas, it's pretty financially irresponsible. I would say that frequent trips to Vegas, or there was a year I did a couple of them, which was pretty irresponsible.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
When the market moves, traders need to move faster. Tasty Trade Active Trader Tool offers full depth of market visibility, one-click order entry, and instant position management so traders can react in real time. While others charge for professional tools, Tasty Trade provides them for free. Opportunity can move fast. Seize it with Active Trader. Try it now on Tasty Trade.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
I'd started to disrupt my trading career like really early on, probably 4 or 5 years into it. I started thinking there's got to be more than just this. Thinkorswim we built in 1999, 2000 when the market was crashing. And Tasty was in the middle of 2010, 2011 when markets were kind of in turmoil. So yeah, it's always best to start things when it's worse. When I speak in front of a large crowd, I usually say right up front, I'm going to try to give you a takeaway every 15 minutes because I think it's important. You came out for a reason, and we respect that, and it's humbling in its own sense. So we have to deliver our part. Like, you can't just give somebody, hey, here's a one-liner, and you take it home, and then you try to figure out what to do with a one-liner. You have to challenge people to think.
If the VIX is over 40, we'd like to see an allocation of about 50%. The reason you allocate more when the VIX is higher is because when you have a higher VIX, you have the opportunity to make more money.
What a day in markets it was. We are looking at the third consecutive day for losses in these stock markets today. They're not as bad as they were earlier in the day, but nevertheless, it looks like things are getting soggy. So is this the turn that we've been waiting for, or will this be bought up like every other false start lower for U.S. equities in recent months? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And what we're going to start with is, as we usually do, a look at the economic data in context of the market performance and what that market performance is telling us from here. Needless to say, there's once again, a little bit of U.S. event risk on the menu, but we'll start with how these markets have performed. And the picture here relatively soggy. Another down day for the S&P 500, another down day for the Nasdaq. They're both off about 0.4% ultimately, but that is much less severe than what we ultimately were looking at earlier in the day for the S&P 500. Just by way of an example, we were down as much as 1.1% earlier. And if we take a look at the same for the Nasdaq, there the swing was even more dramatic. We were down 1.3% intraday from the open into the low, and obviously we've moderated those moves significantly. We can continue to see here that yields were higher, the 10-year up, the front end though looking more potently on the upside, 1.5% for the 2-year. Gold eking out a fractional gain. Silver was more buoyant, as a matter of fact. But on top of this, Bitcoin doing its risk appetite on steroids thing and ending up with a loss of a whopping 3.89%. So really looking quite beaten up here. And if we consider this sort of in the context of how these things have performed this week, we can see there's definitely a theme that is emerging. So stocks ultimately so far this week down almost 1% for the two major indexes. Rates up across maturities. Gold, again, a little bit higher, but it was higher earlier in the week. It's moderated from those earlier gains. It's cut them by about half, but nevertheless still sort of clinging on to gains. And that's certainly despite the higher yields and also despite a stronger U.S. dollar, which now looks fairly convincingly higher against the major counterparts, up 0.75% against the euro, up 1.25% against the yen, the more kind of yield sensitive, the most arguably yield sensitive of the dollar's pairings. And you can kind of see that in the story that you see in yields. Generally, when U.S. Treasury yields go up, the yield differential between the dollar and the yen widens out. And because the yen sort of has perennially low rates for the past 30, 40 years, Japanese rates have hugged zero. There is a kind of natural inclination for the yen to lose, and lose most significantly when U.S. yields are marching higher. And that, of course, is exactly what we have on display here. Now, the bulk of the dollar move, and we'll get to attempting to reconcile some of these others, because, of course, gold being higher and yields and the dollar being higher at the same time that stocks are down, that doesn't so much paint a story of only higher yields and only then a stronger dollar on that basis. There is a larger sort of risk aversion flavor here. And the strength of gold, in particular relative to the weakness of Bitcoin, tells you that this is increasingly becoming a sort of risk on, risk off kind of a dynamic. Gold finding support here then on give or take haven grounds. Gold is not the strictest of havens, but it is oftentimes a kind of reflexive thing that people buy at times of uncertainty, and does seem like that's what's going on here. because not only are we looking at higher yields and a stronger dollar, which typically is kryptonite for gold, but higher gold in tandem, sort of despite those things. But the move in dollar here and in yields very closely anchored to what we saw on the economic calendar. And what we find is that GDP was revised higher in the final look at second quarter data. The expectation was 3.3%. That was the initially reported number. We ended up with 3.8. There was a slight revision lower on the prior month, but that ultimately is not anything that the markets really ran with. Instead, what we end up with is a dollar that surges as we get this GDP data. Right alongside it comes a surge in durable goods orders. Right alongside that come a set of jobless claims numbers that seems to point toward better support for labor markets, at least sort of nominally speaking in this report. We can see here on both initial and on continuing claims, we end up with lower numbers than expected and lower numbers than we've seen for a while. Here is that GDP report, and probably the most interesting thing here is you get a slight upside revision for consumption. That's to some extent what you want to see. The consumption component here edging up, but nevertheless, the overall performance from the sort of consumption side of things not looking terribly encouraging, as we've pointed out. If we look at the contributions to overall GDP growth and consider sort of how much consumption has added, certainly there's been a meaningful improvement in these numbers. The new numbers showing us that of these 3.8% consumption, which is 68% of the overall economy, added 1.68%, and that's no doubt a meaningful improvement over the 0.42 percentage points added in the first quarter. But it is also the weakest contribution since the first quarter of 2024. And if we take these numbers collectively, so the first quarter and the second, we still end up with some of the weakest consumption that we've seen in 3 years. I mean, the last time we saw something comparable was back in the third quarter of 2022, the fourth quarter of 2022. Now, this is much better than these figures looked at first. We were looking at the worst 6 months since the first 6 months of 2020, not just the worst in 5 years, but of the worst since the COVID lockdowns, which is obviously an ominous kind of sign. On final revision, this is looking better, but it is still the weakest performance from the most important part of the economy in just about 3 years, a little bit less. And so what we have here still looks not great, and much of the swing here coming, much of this dramatic swing from a first quarter decline of 0.6% to then a 3.8% surge, much of that coming from what's going on in imports and the response to these tariffs. In the first quarter, imports shed 4.7 percentage points from the overall GDP story, and that's largely because imports get subtracted from GDP, and in the first quarter, in the front running of these tariffs, the import surge really took a big bite out of overall output. Imports then collapsed in the second quarter because that front running of tariffs really made no more sense once the tariffs were instituted. And that collapse in imports took off, or that took off almost 5% in the first quarter, added a little bit over 5% in the second. It's a similar story for inventories. So inventories in the first quarter here were a major source of swing in GDP. Of course, all of those imports for front-running the tariffs went largely into inventories because they weren't servicing current demand. They were stocking up on goods at the pre-tariff rate. So inventories jumped 2.6% in the first quarter. They fell 3.44 percentage points in their contribution to GDP. So the way you arrive at this 3.8 number, much of that is the revision in consumption, but more than anything, it is sort of the difference between a 5 percentage point contribution from imports falling and a 3.44 percentage point negative impact from inventories declining. That, of course, tells us that under the surface of this data, there is a bunch of moving around relative to these tariffs. But more importantly, in this upside revision, what you appear to have is some implications for near-term Fed policy looking less dovish than expected. And so, too, is this view on jobless claims. We can see here, this is a 4-week low right here. So the third consecutive week that jobless claims at the 4-week average are down. And obviously, this surge in durable goods, although it is only a month-on-month number, so it is quite volatile, but against expectations of a decline of 0.5%, 2.9 looks like a relatively potent jump. In fact, if we consider this in context, while 2.9 is not exactly the biggest increase, by comparison, in May, durable goods jumped 16.5%, but it is the first rise in 3 months. So there is something to be said for that as well. And we can see the impact here, the outlook on Fed policy looking less dovish now as we've made the move here. And as we can see, while there's still a disconnect with what the Fed has on the menu, this is the latest from the summary of economic projections that we got just last week. And of course, what you see here is a situation where the Fed is still only forecasting a single rate cut for next year, despite the fact that it's essentially given its agreement on there being 3 cuts this year, which the markets already had largely baked in before the policy announcement. But when we then compare what this looks like with the market's outlook, it's still, needless to say, more dovish in the markets, but meaningfully less so. We're down to just 91 basis points in a cumulative rate cut effort between now and the end of next year. And perhaps most potently, we've worked down the outlook for next year, where most of the easing was, down to just 59 basis points. Now, that's still way more dovish than the Fed's view, which is only a single 25 basis point cut. Nevertheless, it is also the least dovish that the outlook for next year's policy has been since the middle of June. So, in excess of 3 months here. And when we compare then how this looks for this year at 31 basis points, this is of course net of the cut that's already occurred, we're looking at the least dovish since basically the beginning of September. So the markets are looking at this data and they're saying, okay, well, the Fed has less scope to ease. And so they're sort of slowly shifting in the Fed's direction. And when we look at the way that this has looked in markets, we can see here's this initial 25 basis point cut, along with signaling from the Fed that ends up looking less dovish than anticipated. We've, again, seen the Fed only forecast a single cut for next year, whereas the markets clearly have more. And so they've started to adjust this way. We can see, as a matter of fact, right here, that if the base here was around 140, that minus 25 basis points should still give us in excess of 100 basis points in the overall outlook. So it should end up at least 100 basis points priced in, and then about a 15 basis point overshoot, which makes a fifth cut in the sequence about a 50-50 shot, a little bit better. But instead, we've come in much more. And so this would be the markets actually shifting to a more dovish footing, or a less dovish footing, rather. And so what we can see is as the markets digest and as the dust settles on last week's policy announcement, this starts to really weigh on stock markets. And this is where we get this turn. The dollar, of course, following the same sort of thinking. We can see initially a little bit soggy, but now as we get less and less dovish, the dollar starting to really perk up. Now, the next inflection point in this story, as we said at the top of the show here, is going to be U.S. inflation data. And this is the PCE index. This is the Fed's favorite inflation gauge. The expectation is that we're going to come up to a 19-month high on core inflation at 3%, and a 17-month high on headline inflation at 2.8%. Now, on some level, this should not be inherently market moving. First, because the PCE data is relatively well forecasted. Generally, once the CPI and PPI numbers are out, the internals of those figures can be reconstructed for a very accurate forecast of PCE. And so the markets rarely get this wrong, so there's rarely a wedge between expectations and reality that then allows for speculation. But if we look at the way that this has performed relative to the Cleveland Fed's baseline forecast, we can see here that over the past several months, basically going back to shock of shocks, April, where we know stock markets bottomed and kind of the Liberation Day fear was tested, and markets ultimately resolved that the administration is responsive to market discipline, and so we're not looking at the worst of all possible worlds vis-a-vis tariffs and global financial stability. But nevertheless, since that time, we can see realized inflation, headline here, core here, has overshot these forecasts. And that's been going on essentially since we set this low. So let's call it 4 months at this point. And so as we look at this then, The risk is that we might overshoot. Now, for July, we basically came in right on the screws. So no big surprise there. But clearly, we have seen a little bit of a wedge between forecasts and reality open up here. So the risk would be that you get an upside surprise, which wouldn't be particularly helpful given these dynamics here. We can see that the 3-month annualized reading for PCE has been accelerating since May, whereas the 6-month reading has basically held steady. So the dynamics for inflation here aren't helpful if the market is in fact getting worried about tightening, or at least about relatively less easing than it wanted to see. If the market is being forced in the Fed's direction here, let's recall that the Fed upgraded expectations for growth and for inflation, downgraded its outlook for the jobless rate against the backdrop of these rate cuts. In other words, the Fed is trying to run the economy hot, basically betting that inflation will be short-lived, whereas supporting the labor market is where the focus needs to go. If we follow the dynamic here and we get another upside surprise on this, that ultimately makes this look worse, that is to say more inflation and stronger 3 and 6 month dynamics on price growth, well then it's going to be that much harder for the Fed to justify more easing, and this probably has more room to come in, both here and here, which then, of course, seems to portend weaker stocks, seems to portend a stronger U.S. dollar, and generally an extension of these dynamics here. Within which context, then gold and Bitcoin look like interesting opposite sides of the same coin, where the risk aversion becomes the more important thing than any kind of anti-dollar, anti-fiat alternative store of value dynamics, where Bitcoin is taking its cues from stocks and is coming down, whereas gold is finding that haven bid despite higher yields and a stronger dollar and is edging up anyway. And that is macro money for today and for this week. We'll be back on Monday as ever, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm also writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. And we'll be back with you next week to try and figure out what's next. Happy trading.